Now, U.S. regional bank stocks rally as deposits return. The recovery in banking shares comes after Western Alliance Bank Corp reported a deposits growth of over $2 billion since April. Many analysts say that it is too soon to call an end to the banking crisis. But one thing is clear. Worries about the health of U.S. regional lenders are definitely easing. That was reflected in a strong recovery in U.S. banking stocks. The stocks of the most vulnerable since the collapse of the several U.S. banks earlier this year have risen sharply. Shares of Western Alliance and PacWest Bank Corp were up over 21% for the week. The KBW Regional Banking Index gained more than 7.5%. But the latest rally did little to ease the banking industry's suffering. Western Alliance is down about 41% so far this year, and PacWest has tumbled 76%. The collapses of Silicon Valley Bank and Signature Bank, as well as the First Republic Bank, spooked investors. The KBW Regional Banking Index has mirrored those losses, with about 26% knocked off the index in 2023. Separately, a Bloomberg report showed heads of failed U.S. banks mostly blame social media and not themselves. The senior executives at recently collapsed banks, facing a second day of grilling from U.S. legislators, said that social media was the root cause for their dramatic crashes. First Republic Bank was sold to J.P. Morgan Chase in a government-mediated sale. The chief of the failed bank, Michael Roffler, said that the panic was very real and refused to take the blame. Signature Bank Chairman Scott Shea said that panic was flooding through the social media before his bank was seized. Meanwhile, former SVB CEO Greg Becker said that the role that social media plays in the financial system is something that needs to be looked into. U.S. lawmakers, though, blame the executives for mismanaging the risks. Ayanna Pressley, the Democrat who represents a district in Massachusetts, said, "You blame social media. You say similar banks experienced the same thing, so it was not your fault for what happened ultimately." But she added, "The bank failed on your watch, period." For more on this, our correspondent Susan Tehrani sent us this report from New York.
Many analysts now expect a short-term extension for Congress to be able to reach a deal. Back in 2011, when the United States was at a serious risk of a default, ultimately, a deal was reached for $900 billion in spending cuts in the span of 10 years. But even delays have consequences. For example, back in 2011, the standoff, first of all, prompted a downgrade in U.S. credit ratings and also really set the stock market plunging. And then estimates said that those negotiations and the delays cost the American public at least $1.3 billion in higher borrowing costs that year alone.